Good afternoon. Let's look at chapter 13, homework. A lot of exercises here. I think we have 13 or 14. If I can successfully share this, there we go. Let's just jump right in and look at exercise 1. What we see here, let me move my face out of the way here. April 1, Tedesco purchased inventory, $451,200, 5-month trade note payable. It's different between accounts payable and notes payable. Notes payable typically has interest assigned to that. Accounts payable does not. So you can see the journal entry there. We are debiting inventory for $451,200. There's our short-term notes payable. So what do we do at the end of, I guess, September? It's 5 months. September is 5 months, April, May, June, July, August, September. Yeah, we are August 31st through August. So we have interest associated with that $451,200. So all we have to do is just take 4%. I'll do it the easy way here. 4% times $451,200 for 5/12. That's my interest expense. Really short and sweet exercise there. Let's keep moving here. Number 2. Nova Publishers collected $576,000 for 6-year online subscriptions to its magazine. And so we have unearned subscription revenue. So this is a liability account. You receive the cash for something that you haven't earned yet. The performance obligations have not been met, if you remember from chapter 8 on revenue recognition. So there's my credit to the liability. You know, that's what this chapter is about, liabilities for $576. At the end of the year, we want to record $48,000. Well, how do we get $48,000? Well, if we take $576,000, right, 6 years, what is that, 72 months? $576,000 divided by 17 months. So we got $8,000 per month of revenue that we are earning. So we are reducing that liability with a debit to the liability for $8,000 per month. So we're making this entry just once a year and not monthly. So 6 months times 8,000, there's my $48,000 subscription revenue earned, right? Let's see here if I can find my notepad. I'll pull that up while I work some of these. I meant to do that before I started, and of course I didn't. I believe it's that one right there. Let me see if I can get that started. All right, smart notebook. Now let's see if I can go back and there's my smart notebook. All right. So there's my initial 576,000, and so we're reducing that by 48,000 at the end of the year, basically taking it out of the liability and putting it to revenue that's been recognized. So 576 and 480. Unearned revenue, so we're going to take 48,000 out of the liability account, and so now what's my balance? It's 528. So that's the balance. That's the balance on my balance sheet. All right. Back to the homework. Number 2, that takes care of that, and there is the balance, 528. Just want you to see the flow of this and how the T accounts can help you as you move revenue that has not been earned from your balance sheet as a liability to your income statement. All right, number 3. Here's a good one on gift cards. Again, this is unearned revenue, correct? We've got $2,100 of gift cards received cash on May 25th. And then on June 29th, customers redeem $900 of the gift card. So when they sell these gift cards, they don't get to book that as revenue. They've got the cash, but they haven't earned it yet. They've not performed any of the service for that card or produced any goods for that. And so again, unearned revenue gift cards, much like what we saw in that previous example, we put that on our books, on our balance sheet. Debit cash, credit my liability for $2,100. And then it says $900 of these gift cards were redeemed for merchandise that cost $426. So you got 2 transactions going on there, right? First, you're going to take $900 out of unearned revenue and put it to sales revenue, income statement. And in the second part, we're going to move that from inventory to cost of goods sold at cost, right? So then you can see there, 900 minus 426, all right, that gives you your gross margin. $900 minus 426, sales, COGS. So that gives me my gross margin, doesn't it? Was that 474? You didn't have to do that for this problem, but it always helps to try to tie in cost accounting managerial with what you're learning here in financial. All right. Number 4. Here we have another liability, deposit, where we are receiving cash collected for these trash dumpsters that are being not sold, but loaned to people, and hopefully they won't destroy them. And so the initial deposit, $1,100 for 19 customers, is $20,900, right? Then what happens? 14 dumpsters are returned. So what's 14 times 1,100? 15,400. So our deposit liability has gone from 20,900. We debit that for 15,004. All right, so we've got a balance there of how much. We always have to make sure we take it out of the liability for the same way that it went in. All right, this down or I'll forget. And then what happens? It says that the other 5 dumpsters not returned and the deposit is forfeited. All right, so we got to reduce our deposit liability down to 0, don't we? And we're going to take that liability at that point, that deposit, and turn it into revenue. But we also have the costs associated with those dumpsters. The cost of each dumpster is $790. And for those 5 we're going to record, because this is on our balance sheet as me as the company that owns the dumpsters, as inventory, part of my equipment. So I've got to take that off my inventory at cost, and it goes to my income statement as cost of goods sold, right? And then of course, then I've got the revenue to offset that. So you see the flow there? Let me see if I can put that on this notepad again. $20,900. 15,400 was returned, right? So 20,900 minus 15,400 is 5,500. And this is my deposit liability. And so that 5,500 is what I'm going to have to make an entry for to get that to zero, correct? Because those dumpsters aren't going to be returned. And so that liability, that $5,500 cash, I'm going to keep. And so that $5,500 is going to where? It's going to my income statement as revenue. And then I've got the cost of goods sold, right? I don't remember how much that was. Minus cost of goods sold. $3,950. $1,550. Gross margin, because those dumpsters weren't returned. All right. Number 5. Here we've got a very straightforward sales tax question, and just like I talked about on the lecture video on sales tax, sales tax is very complicated in the state of Tennessee, and really most states for that matter, because most states are, Virginia is 4.5%, I believe. North Carolina, I think it's 7% overall. I mean, here it's 9 and anywhere from 9.25% to 9.75%. Of course, there's local baked into that, but still, those are substantial revenue streams that there's a lot of lobbying goes on for what's sales tax exempt and what is not. The question here is just simply, if I've got $2,560,800 and 5% of that is going to be cash I need to withhold and then remit that on a monthly basis with my sales tax forms, then it's simply a what? We're going to collect the total cash sales revenue is without sales tax included, because the sales tax paid was going to be remitted straight to the Tennessee Department of Revenue. All right. Very straightforward. All right, number 6. Here we got a very straightforward question that really has nothing to do with accrual for vacation. Again, most companies are doing accruals. Every company I've worked for and did work for had to perform these accruals. But here we got 72 employees earning $1,400 a week. Each employee has 1 week vacation. They don't accumulate nor vest. This is highly unusual. But nonetheless, 65 of their employees took 1 week during the year. Other 7 employees were not able to take their vacation, so they lost it. They have to have vacation earned, but you don't get to take it. So here we got 65. So the actual transaction is 65 times 1 week times $1,400, $9,100, or excuse me, $91,000 is my expense for the year. And it's a completely hypothetical situation that you're waiting to the end of the year. You would do this on a weekly or bi-weekly or monthly, whatever their designation is for their pay period. And when they actually miss, then you pay them for their missed time. But again, this is cash basis. This is not accrual basis, and that's really the most important part, is the accrual basis of accounting. Let's jump ahead now. Number 7. Doing well here. Of course, some of these are going to really get bogged down. So let's keep moving rather fast. Great part about watching this online is you can stop and pause and back up and you don't understand something, where if you're in class, you just kind of, you miss it, right? End up in my office. All right, so here's somebody that fell and broke their arm, sued the bank, where they fell at the bank. This is 95% likely. Sounds pretty sure, doesn't it? Which the key term is probable. Now, GAAP is probable. Offers, it's percentages. But here, 95% that's probable. They'll lose this case. And so they've got a range here, 160 to 360. You know, that's what's unusual about this. I've already talked about this in the lecture video. But GAAP says if you've got a range, if none of the numbers in the range are any more likely than the others, then you select the lowest end of that, which really sounds like it goes against conservatism principle, doesn't it? But that's what GAAP says. Offers, on the other hand, says what? Take the midpoint. And that makes more sense. You would almost think what would make the most sense would take the high end of that. But at least with offers, you would think a midpoint is more accurate than taking the low end. But what GAAP says, so you can see there, based on that logic, is why you're accruing $160,000. Litigation loss, which goes to my income statement, and then the contingent litigation liability is my short-term liability until this thing gets settled. All right, number 8, a warranty problem here. Says that small power tools, this is assurance type. This is a warranty that comes with anything that you buy in a store that has, whether it's 3 months, a year, 2 years, whatever, assurance type, not a service warranty, which is what you buy in addition to your product by paying extra dollars for. It's usually 10% of the total. Here is an assurance type. So this is baked into what you buy. And so the accrual basis of accounting says we have to make the warranty accrual when the actual item is sold based on historical evidence. All right, so here we've got the estimate is 5% of total sales. So 5% of 8.3 million is going to be my 415,000. Right, 5% of 8.3, there's my 415,000. And this is based on empirical evidence. Then it says in the first year or the year following, right, the year following the company incurred 190,000 actual warranty claims. So we have set up that warranty, right, 415,000. So 190,000 is coming out of that 415. Correct? 415, 190. Again, I always encourage students to use T accounts. Warranty accrual, or whatever it's called, 415,000, and the first year 190. And so now we got a balance, don't we? Whatever 415 minus 190. $225 remaining. Of course, they're not taking that problem that far. So the 190, part of that is giving out more inventory, replacement inventory for these small power tools. Wages payable, I'm not sure what that's associated with, but typically you just take something out of inventory and would give that to whoever had purchased your product from you. Or you give them cash. But here, wages payable, I'm not sure what that's all about, but maybe it's to rework part of what they returned. That could be what that is. That's very straightforward. And then, of course, if you went into year 2, then you would have, as I just showed you there, you would have what, 225,000. Now, what we're going to find in one of these other exercises, what if the next year they actually had that much, right? Well, you can't do that. All you can do is take 225 out, and the remaining 75,000 would just be warranty expense in the year in which that occurs. So you can't have a debit balance in this liability, but that was just beyond the scope of this problem. We'll see that here shortly in another exercise. Just want to point that out. All right, number 9. All right, a payroll problem. A couple of payroll problems here. Number 9, I believe the last one. All right, so what we have here is a company, 1.16 million biweekly payroll. That's paid Social Security tax. None of the employees has exceeded the wage base. You know, there's a wage base for FICA. The 6.2% stops at, this year, I think it's 135,000, something like that. Medicare has no cap, but this problem says that nobody's exceeded that. So it's very straightforward. You're going to take the entire wage base times those percentages. So there's my FICA, that's retirement, Social Security. There's Medicare, right? Once you turn 65, you got health insurance. Federal income tax, they're just saying 28%, which is extremely high. It's going to be withheld from all people's payroll check. You know, what really drives that is your W-4 that you complete when you work for a company. But they're making this simple. And then state and local, 12%. Pretty high, isn't it? So there's the calculations for withholding from employee checks, right? So we can come right down here and look at that. There's the 71,920, there's the 16,820, 324A, 139.2. And if that's my total wages being paid, then what's salaries payable? Well, that's take-home pay. That's net pay on a person's paycheck. If you had other deductions here, like insurance, union dues, 401k, 457 plan, or any type of pension, dental plan, anything like that, those would be additional credits to payables that you would pay those particular vendors. So keep that in mind, but they're trying to make this pretty straightforward. So you always have 2 journal entries that you make on payroll. The first one is the employee wage entry. That's what this is. And the second entry, they're showing the reversal of the salaries payable out of cash. But the second entry really is the payroll tax expense. That's what the company has to pay. And whatever your FICA is, Social Security that's being withheld from your paycheck, the company's paying the same amount for you. So there's the second entry for FICA, the second entry for Medicare, right? So the 7.65% you think is coming out of your check and that's it. Your employer is paying the same amount for you. So every time you earn $1, 15.6%, 15.6 cents is going to Social Security to fund your future retirement and your health care. All right, what about this last part? Federal unemployment and state unemployment. Well, that's an employer tax. Employees don't pay that. This is what employer pays in anticipation if they ever have to lay people off, like we just went through. And everybody's rates are going to go up to where they have to pay more because so many people are filing unemployment. But how do we calculate that? Let me just click on the solution here. It'll be the quick way. It says up here, and they make this a little bit more complicated than they need to. It says up here that the state unemployment rate is 5.2%, right there. And they get an experience rating of 2%. So 5.2 minus 2, because experience rating says I've not laid too many people off, so I don't have to pay the full 5.2. So in essence, 3.2% is what's going to be calculated on the taxable wages. And those wages are capped at $7,000. Once an employee passes $7,000, it's non-taxable. All right, and then the federal is down here at the bottom in the green. It says federal unemployment rate is 6%. Well, if that's 6 and your state's 5.2, then really you're just paying 0.8% federal. All right, so now we've got our rates, 0.8 and 3.2, and there's my calculation, 110,000. And it says up here in the body of the explanation, only 110,000 of the total payroll applies to wages that fall under this cap, meaning under 7,000, which is if you back up the sentence before. So $110,000 represents all the people's wages that are under $7,000 year to date. You can figure out pretty fast, most of your unemployment is paid in the first quarter of the year, right? January, February, March, but you go, that goes away unless you hire somebody. And then, of course, you can hire somebody in October, and then they're going to earn $7,000 in the coming 3 months or so. So that would kick in then, but mostly that comes in at the beginning of the year. All right, and so all you have to do there is plug in your federal and your state And again, that drive, that's your plug number, 93,140. That's your payroll tax expense. All right. Here we have another vacation accrual problem. Well, here they're calling it sick time. You know what I said about sick time? Sick time typically is not accrued by companies. But in this case, they're showing sick time. That's something we need to accrue. But think in your mind, it's probably something that you would do with vacation. So what do we have here? We've got 120 employees are allowed 15 paid sick days per year, and they're currently being paid $141,000. So very straightforward there. We're just going to take 120 times 15 times 141. There's my wage expense I want to accrue, right, at the beginning of the year, or at some point. In this particular case, it looks like they're doing it at the end of the year. Kind of unusual how they set these problems up. You know, that's why I'm having you do that Excel exercise on vacation accrual, because that's more of a reality of what you're going to encounter in most companies. But I can't plug those into the Pearson. Pearson does it a little bit different. So again, here they're making the total wage expense for the year and the liability. They're looking at this sort of like at the end of the year, we're going to make this journal entry, which is really not realistic, but this is an exercise. All right, so it says here that 80% of the employees took that $253,800 during the year. So 80% of the time was taken, right? So 80% of what we just calculated, 80% of 253,800 is 203,040. And so that tells you if that's my total expense for the year, all of which really is a liability. But if I paid out 203,040, then that leaves my liability for compensated absence is at 50,760. All right, going into the next year. Because this is accrued and this is carryover. That other exercise we looked at a few minutes ago didn't have any carryover. It was all cash basis. This is accrual basis with carryover. So this is accrual here, 50,760. But what's interesting about this is what happens. Following year, assuming employees take all remaining days at that time. Very simple. You just debit the liability there and credit cash at the same wage base. C, though, requirement C says, independent of your answer A and B, what if they took all these sick days the next year, but their wage rate increased to $152? So it went up from 141, right? 141 up to 152. Well, are you going to pay them based on 141 or 152? Well, try paying your employees last year's wages for the current year. That really go over real well. You have to pay them at the current rate. So you're going to pay these employees $11 more per day for what they're taking in the current year, which is the next year after this accrual was made. What do you do with that? You got to make the accrual zero because it's over, and you can't have a debit balance. So what do? It's like that warranty exercise. You can't have a debit balance. Well, you're just simply going to debit expense for those wages in the current year, and the credit is going to be cash for the full amount, which they're going to be paid at $152, right? So there you see there in requirement C, the wage expense, $39.60. Let me just show you the solution without having to actually do the notepad. 120 employees times 15 times 140. Well, that's not what I want to look at right there. 120 employees times 15 days, 20% is left over, right? So 20% of those hours or days, 15 days times 120, 20% of those days are going to be paid at a higher rate of $11. So that tells you my additional wage expense has to be $3,960. We're not going to reopen the books from last year. It's not a prior period adjustment. You'll learn more about that in a later chapter. We're just going to expense that in the current year because we made a good faith estimate. We made an estimate based on the current wages, which is what GAAP requires. GAAP doesn't want you to make an accrual in the current year for a potential wage increase the next year. IFR says that's okay. If you think the wages are going to be higher next year, make your accrual based on that. But GAAP does not. GAAP requires you make an entry based on $141 per day. And if you pay more next year, you just expense that additional amount in that year. All right, so the key number there is 3960. Right, there's my expense, there's the liability. See how those zero out? 50,760, 50,760. So my liability is zero, and the rest of that is just being paid out of cash, right? Whatever that 20% of those number of days times the full $152 is what? That's what my actual cash payment is, which was the last part of this down at the bottom. 120 days. Excuse me, 120 people, 15 sick days. We're going to pay them $152, but only 20%, right? 20% of those days. Really, I put the 20% in between here. It would make more sense. So that's the cash that we have to cut out of payroll. All right, it's good exercise because it is a true accrual there, even though they use sick and not vacation. All right, number 11. All right, here's a long one. This is the ARO problem. Let's see if we can work through that. I may have to try and do this on the notepad there. Here we've got ARO, Asset Retirement Obligation. This company bought a power plant for $23,570,000, paid cash. The estimated cost to dismantle this plant, restore the property, and end of the plant's 15-year life is $4.854 million. So they looked out in the future. That's what they think it's going to cost in those dollars. Well, you got to put that on your books at today's dollars. So this 4854, right? 4854. We have to do present value on it. Now you can do it using Excel, which is great. 2% capital, right? PV. 0.02, 15 years is in payment. There's no payments associated with this. The future value. So what's the present value of that? Looks like 3606,593. If you were using a table for this, we would want to use what? Present value, right? Present value of $1, which is that table right there. And if we're going to find 2% there for 15 years, that factor is 0.74301, right? 2%, 15 years, 0.74301. So if we multiply 0.74301 times 4854,000, we get 3606,571. It's off a little bit. It looks like it's off $22 by using the tables. So we want to use Excel because Excel accepts, Pearson accepts the Excel answer, not the table answer. Interesting enough. All right, so present value. So that says it's 3,606,593. If we multiply that by 1.02, 15 times, you would get that future value that your engineers, environmental people have given you as the obligation. So there we got two assets, right? We got the asset, like you learned about in 3010, 23,570. We're going to depreciate that over 15 years, zero salvage. But we also have this pseudo asset that's on our books now with a liability, ARO, as a liability that we're going to multiply by the 2% every year, really every month, but every year in this example. So that 3606,593 at the end of 15 years through accretion expense is going to be what? 4,854,000, right? But this is an asset liability that doesn't exist yet. You've not actually paid any money. You're just funding this. You're just setting this up. You're not funding it. You're just setting this up as an asset that has to be paid for. Not paid for, has to be accrued by the end of those 15 years. Yeah, you better have the money available too to do this as well. So but that's another topic. That's Treasury's problem. All right, there's my depreciation expense, which is both of these added together, 3606,593 plus 23,570. Add those two together and divide by 15. They group depreciation together for some reason instead of having it separate. But then we've got this accretion expense. And that's where we're going to go over here and calculate accretion expense for the first year. And while we go over there, we're also going to see that after 5 years, this thing's going to be sold and not actually fully implemented. So let's go here to the notepad. All right, so what we have here is ARO liability, which we said is 3606. I better not write too big, I'll run out of space. 593, right? So the first year, we're going to multiply that by 2%. That's our cost of capital, right? 3606, 593 times 0.02. So the first year, we're going to have 72,132. $72,132. 36, and we're going to add that to my 3606, 593, which is 3678, 725. So that's year one accretion, right? Accretion expense, debit accretion expense, credit, debit accretion expense, credit, ARO, right? That's the entry we're making. Then we're going to multiply for year two times 0.02, 73, 575. That's 36, 78, 725. Year two. It's going to be good preparation for chapter 14 because this is the effective rate of interest method, which is what we're going to do on bonds payable. 75,046, 3752. 300, 38, 27, 346 times 102, 2, not 3. 76, 547. Year 4, and then year 5 is our last year we're going to do this, right? That accretion expense is going up every year, isn't it? Yep. So there's my balance. You know, why are you doing this, Joel? Because that problem said at the end of 5 years, this power plant is going to be sold. And so we have to know what this balance is. That's on our balance sheet. We got to take this off our balance sheet at that amount, don't we? Now, I didn't look at the answer, but hopefully this is right unless I fat fingered something. That should be the entry that we're going to make, 3981,971, to get that off the books. Of course, we're also going to get the asset off the books as well, aren't we? That's being depreciated. But this is how most students struggle with, is trying to come up with what is the balance in my liability after doing all this accretion expense, all of these years, 5 years. So 3981,971 should be $39,81,971. There it is. Asset retirement obligation. But before we get there, we also have this cash that's being paid. Rundle sold the asset for $16.9 million. So I'm receiving, if I'm Rundle, and I've got the power plant I'm selling, I'm getting $16,009,000 for that. There's my cash. There's the original cost of the building, right? $27,176. Plus what? Plus the actual present value, the $36,065.93, right? That's my $23,570,000 plus my $360,6593. There's the 593. See, they grouped the asset and the building itself. They grouped the ARO asset and the building both together into one. All right, there's my accumulated depreciation from those years. See, there's the depreciation. If you multiply 773, we multiply that by 5. $773 times 5 is 9058865. There it is, 9058865. Right? And so once we know the cash that we're getting for this, we know we have to zero out accumulated depreciation and we have to zero out the asset. The difference is either our gain or loss. And if it's a debit, it has to be a loss, right? Expense, debits. All right, so we've taken care of the asset, but what about the liability? There's the liability that we just went through. There's the debit, $39,81,971. It also says up here that the cost of dismantling and plant restoring the property total $5,420,000. So there's the $5,420,000 that they had to pay at the end of 5 years to dismantle this thing, even though they sold it. And so the difference between the ARO and the cash paid is, again, another loss. That's a big loss, isn't it? That $5,420,000, that's even more than the $4,854,000 they thought it was going to be 10 years later, right? So they did a pretty poor job of estimating what it was going to cost. So you got two things here. You got a loss on your asset that has been depreciated versus what you were paid for it. And then you got a loss on the ARO that you've been accruing through accretion expense and what you actually had to pay to decommission, decontaminate, restore whatever the property, what it should be. All right, that's a long exercise, but it's a good one. A lot of things going on there between assets and liabilities. All right, let's keep going. Number 12. Oh, a good one, a short one. Customer fell on an icy patch, broken ankle. Company's attorneys believe it is reasonably possible. What did I say about reasonably possible? It's probable, what? We'll make a journal entry. What about reasonably possible? Reasonably possible. No journal entry, but we disclose it, right? Remember that? And reasonably estimable, journal entry, and disclose. Reasonably possible, disclose. What about remote? Nothing. Very important. This is going to come up when you get to the Excel exercise on OPEB later. What's probable? I didn't do a very good job of spelling probable, did I? Probable. 1, 2, 3. That should be going through your mind. I can't tell you how many times you're going to be thinking about this in your career when you're making contingent liability entries. All right, so this says that what? After we determine that a contingency exists, we assess the likelihood of incurring loss because the loss is reasonably possible. Fire and does not record a loss, nor record a liability, meaning no journal entry. Because it's reasonably possible, amount can be reasonably estimated. You usually can. You just disclose the contingency in your statements. So there's no journal entry, no impact to your financials. All right, number 13. All right, here's another warranty exercise. And this is one that they're going to show you both the cash basis and the accrual basis. You may work for a company that's cash based. It may be small. If you're small like that, you can do that. But if you're working for the majority of companies, most of which are going to be required to do the accrual basis, well, let's just see. All right, so the first part, A, is prepare the journal entries under the warranty, assume they use the cash basis. Record a journal entry in the year sale when Sam used the cash basis. Well, you don't make a journal entry. There's no accrual. You're only going to record an entry when you actually have something returned. And so it says the first year, actual repair costs first year after sale were $222,000. $153,000 for inventory parts, $69,000 for labor. Yes, people working to fix whatever was wrong with these LCDs. So there's debit expense, year one, debit expense year two, there's no accrual. All right, so let's jump to the next part, part B. Because this says we are going to make an accrual, right? First, record, and you're going to do this on a daily basis as you sell these things, automatically. And it says that the warranty, assurance type warranty is 4% of sales. So 4% of $10,006,000 is $400,240. $10,006,000 in sales times 4% is my warranty. $400,240. Write that down. $400,240. All right. You're using the same date up here, so there you see $222,000. It's going to reduce that liability, right? $222. It's not the expense though. You've expensed in the year in which you sold it. So there's my debit to the liability. There's the parts and cash again. There's parts and cash in year two. But year two is how much? I guess it's $178,000. No, it's more than that. It's $231,000. What did we just say back there a minute ago? You can't go debit with the debit balance on your accrual. So your contingent warranty liability can only be $178,240. The rest of it just gets locked into warranty expense. No prior period adjustment, no opening the books. You just eat that cost in that year. And there's my parts and cash. So if we go back over here and look at the T account, which might help you understand this more if you're struggling. Warranty accrual, $400,000, $240. My first year, $222. And we know with the trial balance, we know we have a balance of what? I shouldn't even have to use a calculator if I could just remember those other numbers. $178,240. $178,240 is my balance. My trial balance, right? So this entry in year two, right here, can't be anything more than $178,240. That's my limit. You can't have a debit balance in your warranty. So $178,240 has to come out of the warranty accrual because the 2 years is up. The warranty is over after 2 years. Anything beyond that just is going to be expense. Again, let's go back to the exercise. And there's the $178,240. The additional amount just gets expensed in that current year because you made a good faith effort. That's what estimates are. These are estimates. Good faith estimates don't require, it's not an error. It's not a change in principle. Good faith effort, you just change the current year and going forward. So you just put it all into warranty expense. Very similar to what you're doing on that Excel assignment for vacation. Same principle, right? Same principle. You don't go back and change for a wage increase in the prior year. You just eat that in the current year and go forward. All right. We've been going at it here about 55 minutes, so let's get to the last one here. And this is another payroll problem. So again, you got two entries, right? You got your wage, you got your employee wages entry, and you have what? Payroll tax entry. Two entries. Employee wage entry and the payroll tax entry. All right. They make this a little bit more complicated here. It says their total wages are 64. There's my debit to expense. Says employees pay Social Security tax at 6.2 and Medicare tax rate 1.45. Income tax 28% for federal, 11% for local. Very similar to the other one. The company pays federal and state unemployment. Employees never pay that. It says the federal unemployment rate is 1.7, the state unemployment rate is 4.3, and a wage base of 7,000. Okay, legally gets a 2.5% credit. So in reality, they're paying what? 1.8% for state. Yep. Payroll for employees that exceeded 7,000 is 2,143,000. So that's the base for those federal, right? 1.7. You don't have to do a calculation on this one like you did the others. 1.7 times that is going to be your federal. And then 4.3 minus 2.5 is 1.8 times 2,143,000 will give you your state unemployment. But it says here, payroll for employees that exceeded the income base for Federal Insurance Contribution Act, that's Social Security, is 248,000. So these are people that are beyond the wage base of, in this year, I think it's 135,000. People who have seen it's 248,000. So the full amount, that 2,864,000, not all of that is going to be multiplied by 6.2%. 2,864,000 is going to be multiplied by 1.45% for Medicare because there is no cap. But for Social Security, we have to what? We have to subtract out that 248,000. Well, let's do it the easy way. So me trying to do on a scratch pad there. They're showing 2,864,000 minus 248. The wage base is 2,616, right? Times the 6.2%. Again, 6.2 and 1.45 is 7.65. But if you're making a lot of money, you are capped on your FICA withholding. All right, so 2,616 times 6.2. There's my FICA. There's the full 2,864,000 for these other calculations, right? That's the only one that's got a cap. All right, so there's our numbers. You should be able, I don't know if I can move this out of the way to, there it goes. See? Just transfer those over as payables. Social Security goes to Social Security Administration, that and Medicare. Your federal income tax goes to the Department of the Treasury, and your state and local is going to be, I don't know, whoever. We don't have that in Tennessee. We don't have to worry about it, but we go to Tennessee Department of Revenue if we had a state income tax. Thank goodness we don't. All right, and then the difference in the 1,326,080 and the 2,864 is my what? Net pay, take home pay. And there you have it. All right, and then there's the reverse of the salaries payable out of cash when it clears your bank through ACH. And then we got payroll tax expense. So you can see up here, the FICA and the Medicare are identical, 162 and 41, 162 and 41. They're always the same. Whatever comes out of your check, the company has to pay the same amount. It's double. So the federal unemployment, let's go back up here and look at the solution. So I don't have to work it on the scratch pad. And remember, it said 2,143,000 is the amount in excess of the 7,000. Payroll for employees that exceeded $7,000 wage base, because that's the cap, is 2,143,000. So we've got to subtract 2,143,000 from 2,864. That's the wage base. So we take that 721 right down here, multiplied by the federal, which is given, 12,257, and then there's the 1.8. That's the calculation we did right there. 4.3 minus 2.5. Because they haven't laid many people off. Their experience rating is high. The higher the experience rating, the better. The less taxes you have to pay for unemployment. So 721 times 1.8. So those two $12,000 amounts go right down here at the bottom. All right. And then your plug number is your payroll tax expense. Fantastic. We got through that in less than an hour. That's amazing. I went fast. All right, so that is chapter 13. Hope you gained some knowledge from these exercises. If you have any questions, as always, email me and I will get back with you just as soon as possible. But I hope you have a great day.